Market makers and market shakers, ladies and gentlemen. At the end of the day, we're traders, all interested in making money. Market makers are just bakers. They're very interested in bread, to the money, getting to what is needed. Market makers are a really interesting point. I wanted to talk to you guys about some interesting aspects of trading that we don't always talk about that are really useful just to know. It's some interesting little bit of trivia for you. You know, market makers really exist on the fringe, they operate on the peripherals of exchanges. Sometimes are the exchanges, depending upon the product that you're trading. Markets are really meant to create liquidity and market depth in assets that otherwise would have large spread or lack of liquidity, i.e. lean hogs. There are a lot of different assets that have a variety of difference in terms of liquidity. The S&P 500, for example, has a lot of liquidity, so not as many market makers are necessary. They still participate because they're interested in making money, but they're not always necessary. Market makers were originally invented to make sure that there's as liquidity in the market as possible, to push down the cost of trading for retail traders and really encourage as many people as possible to participate in the market. But just to go a little bit more into the origins of the whole thing, I want to break down a little bit on how markets move. In order for price to move from $1 to $2, say on a regular equity, a buyer's bid must meet a seller's ask until neither are left, but the buyers still want to buy. That's how price goes from 1 to 2, 2 to 3, so on and so forth, vice versa. And this is a simplified way of thinking about it, but this is the core of things for any market: supply and demand.
Yep.
When trades existed solely on a trading floor, this matching of trades was 100% possible. Don will tell you he would call in to make his orders back in the 80s. Some guy that looked just like Jordan would pick up the phone on the other line, and just like Jordan, I say just like Jordan because you guys don't know this, but that polo is a very beautiful cashmere polo he got from Switzerland. That's why he trades the Swiss franc so often. He would answer that in this beautiful polo with the Rolex watch on and say, "Don, what do you need?" Don would buy a contract. Then he would call down to then Jordan would call down to the trading floor and get that contract traded. When electronic trading came to be, it wasn't possible because all of a sudden thousands of transactions were coming across the desk in mere moments. Billions of dollars were trading hands within a matter of hours. So market makers were made necessary today in order to make sure that all of that liquidity is possible. You know, again, this is all about creating liquidity, lower transaction costs, and facilitating trades in order to make these things happen. Now, again, market makers can be either the exchange themselves or a third party, depending upon the asset you're trading. But obviously, market makers can make money on their trades, but they are oftentimes also paid additional fees for their services on their markets. Just for a little fun times, I wanted to show you guys what lean hogs looks like right now. This is a screenshot taken at 3 p.m. Okay, so it's not a crazy time. People still trade at 3 p.m. Okay, This is the futures contract. This is the current month of lean hogs. That little red number that you see, a little red box, it may not show up well on your screens. I'll break it down. That little red box shows one person on the ask. The little green box shows 10 contracts on the bid. The little yellow area is where this thing is currently trading. There are 11 people. It's probably just one guy playing the whole market. It's probably just Jordan on both sides of this market. But this is why market makers are necessary, because the spread on this thing is crazy. Usually we see a spread of a tick in futures. That means usually the price is sitting, the ask is sitting somewhere on this side, price is here, and then the bid is sitting right here. That is what we're accustomed to in futures. This giant spread exists because market makers, they have to come in and support this thing because nobody's really trading it. This is just a good example to show you why market makers are necessary. Now that I'm done with Jordan's trades, talking a little bit about different kinds.
Being attacked.
I wish I was joking with you. I had to look it up. I was just so curious. I was like, what is the market depth on lead hogs right now? That's a screenshot from today. I wish I would have cherry picked that, because that was it was just perfect. I had to throw it in. Anyways, in CFDs, so CFDs, market brokers, they still exist in a couple different ways. You can still have third-party market makers, but oftentimes market makers are brokers. There's not as much regulation in the CFD space because CFDs are incredibly popular around the globe and countries far and wide. So there isn't one regulatory body that they necessarily have to answer to, so they can do things like this that would not be okay trading futures or equities here in the US or say in Britain. The reason why market makers are often brokers in the CFD space is because even conservative studies show that about 70% of retail traders lose money. So some brokers act as their own market makers, taking the opposite side of their clients' trades in order to produce an income. Now, Jordy, I know you've dealt with a collection of different firms. I understand that there's one broker that does this where they are, you said there's an A side and a B side. Is that right?
Yeah, A book and B book, like the two kind of CFD broker setups. Same with firms. Anything kind of CFD, you got A book and B book. One will take your orders, take the commission and the spread on that order, and then replicate that order on a larger exchange, much like what you kind of explained, where you call up your broker, you say, "Hey, I want to do this," and then they execute it on the real market. That's what kind of CFDs are like if you're on the right side. So the broker will the commission is what the broker will be paid, and literally only that commission on spread, and then they'll replicate that order straight onto Deutsche Bank or one of the major trading banks. Whereas if you're looking on the other side, right, and they've got a dealing desk, they're going to take the exact opposite side of your trade. So instead of when you pull the position, the cheeky buggers are still going to charge you commission and spread, right? But you open that position, you charge commission, you charge spread, and then instead of it being replicated onto a major bank or a major trading platform, what happens is they just take the other side. They fill your order, which means if you win, they lose. If you lose, they win. Plus, they get the commissions and the spread. So, the two. Look, realistically, most of them are the shifty one, and it's pretty tough to find out which one your broker is without going in there and having a look around and getting an understanding of what works. But yeah, those are the two major models.
It's tough. It's really tough because, again, how would you know without going in there and asking the right questions and then hopefully having someone that's honest with you? It's a very difficult space to be in. And again, CFDs are incredibly lucrative. Billions of dollars trades hands in this thing. Currencies are the biggest sector of speculative trading that you could possibly be a part of. So this is one of the reasons why we see market makers act as brokers, act as market makers, and vice versa. Whereas in something like equities, for example, just as Jordan was saying, market makers make money on the spread. Most of the time, market makers in equities are usually referred to as designated brokers. They make money mostly from spreads and from taking on inventory. What does that mean? Well, take company A. It's trading at $100 a share. A market maker can post a bid to buy 1,000 shares at $900.90 and an offer to sell 1,000 shares at $100.10. If both orders fill, they make the difference. They make the spread between those two numbers, which in this case would be 20 cents per share or a $200 profit. Now, obviously, market makers aren't dealing in numbers this small. We're talking about thousands upon thousands of shares that are being traded at the same time, but that's the basic idea. When you're talking about the other side of things, of course, I put our little heads right over the end of this paragraph, but say with me. Inventory. There we go. Inventory. So say a equity has an imbalance in supply and demand. Market makers will step in and often accumulate a large position in that equity. A great example of something like this would be something like a GameStop situation. I'm pretty sure everyone here is familiar with that. GameStop at some point had a really strong push against it. No one really wanted to buy it for years leading up to the great GameStop run of the 20s. That's probably what we're going to call it, the great GameStop run of the 20s, when we're explaining this in 20 years. Prior to that, no one really wanted to buy the stock. It wasn't incredibly valuable. So market makers had to come in order to make sure this thing had liquidity. So that's a really good example of how inventory works. What happened from there was, as this stock became a really hot commodity and people were buying this thing up, market makers were able to hold that stock if they desired to, and then sell on the way up, making money on that position. Now, of course, it doesn't always work this way. Market makers are taking on an incredible amount of risk to participate in market making, but these are the two ways that market makers make money in the market for the most part. In addition to this, of course, they have the commissions that they're getting from the individual trades. They have fees that they're getting from the brokers that they're working with, as well as the exchanges. But these are two ways in which they actually make money. It's very similarly to how traders make money. That, boys and girls,